Dana and I are Broadway fans, I guess, growing up in the New York area, as we did before we moved down here to Florida. By the way, for those of you who are new to Sun Garden, that's how the Sun Garden name came about. We moved to the Sunshine State from the Garden State in 1997. And we saw Les Miserables, Les Mis, but I was thinking about another uh, pretty popular show, Hamilton, and there's a song in there that says the room where it happened. You know, you're in the room where it happened. And uh, about an hour ago, got off a call with my friends over at Bytrade. This is the new site, app started by a couple of real entrepreneurs, one originally from Amazon, the other from JP Morgan and Goldman. And my portfolios, the main ones, the two ETF portfolio, the 10 ETF portfolio, are available at pietrade.com, where for basically, I think, no cost at the beginning and not much after that. The portfolios that I am running for myself and show you here can be traded over there automatically. Set up an account with international brokers, etc. And they're up and running. My friend Jack Bowman, who a lot of you know, is also on that platform as what they call copy traders or strategizers. But the reason I'm bringing up my friends at Pie Trade is earlier today we completed the testing of a project that I've been trying to bring to my audience for 4 years. And that is the automation of the Roar score, uh, return, opportunity, and risk. We've had a lot of false starts, more than a bad offensive line in football. A lot of false starts, but we got there. I know we got there this time because I saw the numbers and the proof. And the bottom line is that as opposed to simply giving you every Tuesday, like we do here, I think you can all see this. But toward the end of the weekly here, I will update the Roar score. Where is that thing? I think it's in here. There it is. Okay. Instead of just giving you this Roar score weekly update, we can do just about anything we want with Roar, you and I, which means we can run it for many different securities. I'm testing it out now with all 9 of these, plus the SP 500. Bill doesn't really have one, it's T-bills. But the whole idea of Roar, return opportunity risk, the whole idea of Roar and the Roar score is that the way investing works to me is not how much do you want to own something. Well, gee, if I get up the courage to buy a DIA, or I want to go into something like RSP, which is a equal weight ETF, or I want to own gold. My issue with the way most self-directed investors operate these days, and it's something I didn't really know when I was, in advisory business running funds. I mean, I wasn't interacting with so many people in kind of the general investor population. I had my clients, I had a couple of fund gigs, and that was it. But what I've come to realize is that the self-directed investor, I mean, it's not your fault, but Wall Street is not teaching you. They're teaching you, oh, our commodity is going to be big in 2026, like a lot of them were in 2025? Or can gold keep it up? Or will volatility rear its ugly head? Well, it does at some point every year. How will bonds do? Is Bitcoin ready for a big run? Okay. This is not investor education. This is selling to you. Okay. Not this. Okay. But when everything's about picks and tickers and whatever, okay, it's about portfolio management to me or portfolio construction. And here's how I frame it up a little bit differently. Well, the NASDAQ has done pretty well. I have no idea how it's going to do next year, but I know this. I did a lot of work in the background and now share it with you to say, okay, in normal times, I want to have 20% in here out of the rest of my portfolio. A portfolio that plays offense and a portfolio that plays defense, and it does it at the same time because I do not want to have to guess my way through every bull and bear market cycle. So, okay, there's a minimum amount I'm going to have here. There's a maximum amount. I'll allocate each one, and this is neutral, kind of like the long-term average. And yeah, these two are here right now, but how am I going to figure out when I should have more or less of these, or more or less of any of these? There may come a point where risk has gotten so high that I want to have this wild card VIXI, which is almost like owning a put option on the S&P 500. Not quite, but it has kind of a levered effect, so we try to keep it low. Um, you know, am I going to traffic in these any more than I normally would? Am I going to put a ton of money in cash? I mean, look, there were times in the last 3, 4 years where I would have been running this whole thing like I am now. I would have been 70% cash, no question. Might have been 70% cash, might have had a little bit in bonds and equity, but I would have had a big position in this too. Because, and again, it doesn't have to be these 10. Uh, but investing is about constructing a portfolio with offensive players, defensive players, and a mechanism to go between them. So I can figure out at any point in time, let's say every week, every Tuesday or Wednesday, okay, when we put this out, what should the current weight be along this spectrum? Well, how are you going to figure that out? You can guess, you can do like I do, and you can chart them. But I mean, charting them is one thing. Another is to say, taking, in my case, over 40 years of charting and distilling that down into a single number every week, the Roar score. And that's going to tell me what my level of risk that I want to take in each one of these. Not how much I can make, because we never know, and we just assume we can always make money in something. But how much risk are you taking to own it? Well, you're taking a little more risk in gold and silver right now than maybe you did before, because they've gone parabolic. Um, there's risk in all this, but figuring out a way to bring this all together. I've done it manually for a long time. I mean, I can afford to do that because, I'm doing this all the time. But for the people that follow our work and read my articles, uh, we wanted to take Roar for the longest time and basically put it in your pocket. And I think we are finally going to be able to do that in early 2026 because the folks at pietrade.com and I have figured it out. So much so that the portfolios are run there probably within weeks are going to be automated. Like I won't even be putting the trades in myself. And that can happen soon, I think, for more ETFs than some stocks. I mean, we do it for just about anything. So the idea that it can say to you, and you don't have to listen to it, but it can automate as much of the work as you want it to, so that in the same way that an automated vehicle, you still have to be at the wheel watching, but you don't have to drive. And so giving the individual investor a spectrum on which they can do that. I want fully automated. Now I want to do it myself. This does it. This does it. And it does it with something that the Roar score, which I didn't make up out of thin air, all I did was I looked at how I look at charts, and I worked with a great programming team to convert that into a single score. So I'm just telling you, it's really exciting. I'm having a hard time containing my enthusiasm, but we literally just said, yes, it's QED, as they say. It is proven. It works. It's only taken me 10 years probably to get to this point, but especially the last four as we've been running the two ETF portfolio. Uh, the other thing is, look, now this thing will be able to outlive me because it's great that I can scan the charts constantly. But like I say all the time, my late father, and for those of you who are new, I don't know if this will show up, Carl Isbitz, there he is. Um, he only had one student really, and that was me. I was fortunate enough to be able to do this for a long time professionally, managing funds, managing client base, all the writing. So I got a bigger audience than he had, and I want to have something from all this work that doesn't just sort of stay here, and that's why the writing and all that. But with this roar really coming through, this is going to be something. So anyway, that's my long introduction to what will probably be a shorter than usual call today. Um, Welcome to the new folks. I am looking forward to your questions. Before we do, I'll give you a quick little breeze through.
Hey, Ron, let's pause and congratulate you for the decade of work. That's pretty cool, man.
Oh, well, it's been longer than that, but I've been trying formally to get this thing automated. Because look, I mean, matter of fact, and thank you. Here, okay, I'm going to show you exactly what I do.
Is that the two ETF version that's automated?
The whole Roar score is automated, my friend.
Okay,
The
cool.
as in you can apply it to anything. Okay, pretty soon what you're going to see is the regular roar, which really is the moderate score, the one that I've been putting out, which is suppressed because I'm a conservative investor. If I think that, or I should say, if the mechanics of roar produce something that says, well, risk with 100 being S&P level risk and zero being like T-bill level risk, if it's at 50, then a moderate roar, and this is where you can apply it to yourself. I'm a moderate risk investor. With this money, I'm on moderate risk. It's a 50. Well, my roar score right now is at 10. Why? Because combination, one, T-bill rates are still extraordinarily high, so you're getting paid to not take equity market risk. And secondly, as I say here all the time, I'm a chicken shit investor, which I wear that, proudly because, you get to the point in life, or hopefully you do, where you say, yeah, I'd like to make 40% in 2026, but ain't no way I'm going to lose more than five. Ain't no way. And that's how I think. That's risk management to me. And by the way, it's 5% for me. That's my max drawdown that I'm willing to. It used to be 10, it was 15, it was 10. Now it's 5. Um, and it's partly because I don't trust the way markets operate. I know how to operate within them, but I do not trust. I mean, Look at silver the past week, okay? Microcosm, all right? Look at Bitcoin over time. Yeah, by the way, I'm writing an article, next one on Seeking Alpha. Hopefully, we'll get it out tomorrow, if not in the new year. But the bottom line is Bitcoin, I think, is the returns like the last 4 or 5 years, very mediocre, very average. A lot less than SP 500, but the average stock hasn't done well either. So there's a lot of window dressing or kind of people not going too deep with this, and that's where the Roar score can end up being the truth, because what it basically does. Let me show you this here. All right, here. This is the Dow 30. So if I want to get an idea of how the Dow 30 goes, well, the first thing I do is say, okay, I'm looking at the 20-day moving average. I'm looking at this PPO that is threatening to cross down. I don't know if it's going to be one of these or if it's going to be one of these. Okay. But that would be dangerous. And now I'm going to go through the rest of them. And I'm going to say, okay, okay, okay. And, I'll keep going. By the way, that one caught my eye. It's Cisco, which I've been tracking. Okay. Not rolling over yet, but getting very, very close. Well, yeah, for the longest time, I thought, okay, how am I going to take this? And I mean, look, what about the whole S&P 500? Okay. I can do screeners and things like that, but then I'm using other people's stuff. Okay. And look, I'm a technician, but what a lot of technical systems do is they overload at the top. They don't get the extremes right. And so what will happen is, and I'll just take any one. Let's see. I guess silver would be a good example. Okay. Okay. Look, silver is a strong buy. Okay. 100% buy. This is in the bar chart system, which is not bad. But
Yeah, 80% RSI though. Yeah.
thank you. Thank you. Yeah, I'm not a huge RSI guy, but it kind of works the same way. Yes. Right.
Although with the way the options are skewed, the implied volatility is really high. You can put on some butterflies for really cheap money.
Yes, I was going to say you're. I'm ready to offer you a analyst spot here right now. You keep talking like that. All right. Talk options to me. So uh, but this is. I mean, look, there's a million people running around TikTok and Instagram. Okay, well, the moving average is rolled high. Yeah, of course. This is high probability stuff. I'm not going to come to you and say, over here, hey, this commodity will double in a month, okay, which it practically did. All right. But I would never go and say that. What I do through the Roar prism, and this is only one time frame daily, okay? But what I do with Roar is I say, all right, if I'm sitting right here, well, that's looking pretty good. And if you've been with us a little while, maybe you know why I'm saying that, but bottom line is it looks pretty good. It looks like it's early stage rally. Now, does that mean I'm 100% sure? No, because you're never 100% sure investing. This might be a case of, you know what? I would say there's a 60, 65, 70%, maybe an 80% chance, okay, after it breaks through here, that this can go much higher. But markets are so frenetic right now, and I don't think it's going to change with the algorithms and the index flows. So that can do that for you. But once you start to get moves like this, and we had this with gold, we had it with Bitcoin, we had it with NASDAQ, had it with Nvidia. I mean, it's been a year of these, right? People forget what happened in March and April until the social post saved all for now. So when you see something like this, one of the things I do Like when I look at this, it's not a normal technical system. Or I should say a normal technical system would see this chart and say maximum bullish. And I would say the more it goes up, the less I'm willing to risk that it keeps going up. Trees don't grow to the sky. Okay. And that doesn't mean I'm selling it because this is not about, I'm not saying, oh, I'm going to buy it here, I'm going to sell it here. What I think this is Roar in a nutshell. Okay. Here, I would say there's a 60% chance, 70% chance. Okay. I'm having it's automated now, so I don't have to decide because I've taught it how to read the chart. I've taught a programmer how I read the chart. And the programmer, who happens to be one of the two founders of PyTrade, is has made it so that it is automated to the point where I can trust it. Okay, and I don't trust very easily. I'm sure you realize if you've been with us for a while. Yeah, I'm skeptical of everything. So that's how you become a risk manager, by the way. Uh, So as something starts to go up, I'm not telling anybody necessarily what to do. I'm telling them risk is lower than normal, which means I might, if my maximum position in this was 5% of my portfolio, I might be at 4 or 5%. Up here, I've already cut it back down. And this actually equates to a ROAR score of closer to 40 um, because it's stretched. That's the term I use. You're going to see us put a lot more content out about this. And if you haven't been to the Substack, etfyourself.com, that's really where all the stuff is housed and will be housed. And I mean, 2026, just like my article said, this is going to be the year of the two ETF portfolio, and it's going to be the year of the 10 ETF portfolio and anything in between. Because what we're now building with the Roar Score automation project is picture it this way. My ultimate goal, and this will be a goal to try to get to maybe by Memorial Day, hopefully we can, is to get to the point where anybody listening to this, okay, certainly anybody who's a subscriber to any of the services we have, um, will be able to say, all right, I want to create my own. I don't want 10 ETFs. I want three on offense and three on defense. I don't need Bitcoin. I don't need this, whatever. Okay. Pick three here, pick four here. Doesn't matter. Pick two or three on defense, and that's what you're going to do. Now, Sun Garden, can you tell me not what I should do, because we're not making investment recommendations, we're not giving advice, at least personalized advice. What we are doing is helping people construct their own portfolios by saying something like, all right, if those are the six that you're using and your risk tolerance is somewhere between very high, very low, or in between, once a week, let's assume it's once a week, maybe do monthly, quarterly versions also. Once a week, basically it's going to say, here's what we would do. Just like I am doing. See, this article does not, this is a Seeking Alpha article, and it is not, it doesn't show you what the current positions are because that's for subscribers. That's where we stop short. By the way, I will tell you, Dana and I are still kind of in shock. We thought this would be a well-received article. We didn't think it would be my most read macro article and second most read article ever on Seeking Alpha out of almost 700 articles. 150. I mean, I see why. I see why. And if you were ever thinking, gee, I should tell somebody about the investing group or about ETF yourself or the lower cost entry point and whatever. Okay. Um, if you ever going to tell somebody about like what we're doing because you think it will help them, this would be it because the best endorsement we can get is that people are reading my articles in both places here in bar chart at a rate that I have never seen. It's like by a factor of 5 to 7 times. And that includes the growth of the Seeking Alpha audience. I mean, we're at 10,000 followers now. I think we're like at 10.5 already. It's been like 2 weeks. So again, this is not to brag. This is to say it is pretty obvious from the standpoint of what are people interested in and where is investor, do-it-yourself investor education and learning going, as opposed to all the garbage that we see on our phone screens every single day, playing to the greed in all of us. I'm not very greedy, but we all have a little. They're playing to the greed. And frankly, I think they try to play to the ignorance and the arrogance of investors. And there's plenty of both right now. I see it every day. So instead, to be able to go in and say, all right, now look, user number one is going to be me. Okay. I'm going to run an eyeballs version and I'm going to run a automated version of this as soon as it's ready. And so this is the current weight. But you know what? How do I know that I have this accurately? Um, and we've done enough back testing of Grur that we got it to replicate pretty much what the history of the Roar score is. Um, so yeah, we're feeling pretty good about that. Let me walk you through the rest of this. Okay, this article I think well worth the read. Okay, if for some reason you don't have access to it and you would like it, let us know. Oh, the other thing I'll say, and related to that, we're going to try something. We'd love your feedback once you see it. This is what it looks like in a raw file. Dan is working on it. Um, a weekly digest. Okay, Seeking Alpha allows us to take any of these articles. This is 2,500 words, something like that. And I put out a few of these a week. I put 5 to 10 out for bar chart, depends on the week. But Seeking Alpha will allow us to repurpose up to, I think, 250 words, no graphs. So what we're doing instead is we're creating a weekly digest where we pretty much, tell AI, hey, take all these articles, come up with the most important things that people should learn as a takeaway, as a Reader's Digest version, and we'll put a couple of new charts in it. Poof. Sunday mornings, you'll have the last 7 days sort of in review with highlights from some of those articles. That will also make it so that people who are not subscribers to Bar Chart or Seeking Alpha will be able to get the gist of what we're talking about. And, of course, it all feeds in to the Substack site where all this stuff lives. Okay. I mentioned that just now. Let me see. We're also doing a kind of a best of the weekly roar, which used to be called the Threes Report. But I want to look back through everything that we've done in 2025 and um, see if there were some particular highlights, lowlights, or things we can learn from. Okay. It might be as simple as picking out some old chart and saying, "Oh, look what happened to this." It's always cool to go back and see, what did we see, what were we talking about, and how did it turn out? And I'm never afraid of saying, "Boy, I really misread that." Okay, so let's see. Uh, okay, couple highlights from today's weekly. I'm watching this because look, I mean, the market, it's hard for me to find a lot of stocks or ETFs that look good. And everything's kind of on hold for another few days, probably till Monday or so at least. But look, would not surprise me if 2026 started out with with a big downdraft. It also wouldn't surprise me if it started out with a huge run up. But I think if it's a run up, it's almost like 2022. If it starts with a huge run up, I think it's less likely to last. I think that if it starts with um, with a downdraft, probably more likely to stick. But I'm just speculating. I'm going to let the Roar score tell me. So, because it's going to tell me how much risk I'm taking for the investment decisions that I make. But I'm noticing this, okay, last 3 months, a lot of nothing here, okay? The healthcare sector did pretty well on a pop, everything else kind of moderate. Um, and boy, this reminds me a bit of year 2000, okay, where suddenly these sectors started to come to life, these three, in 2000. NASDAQ started the year as a house on fire, then it fell hard, really hard, like 75%. Um, and then we went through a few of these charts. The bank stocks, you'll see what I wrote in here, but yes, this is the key part. All right, this is regional banks. It looks a little worse than the banks in general. If it's signaling trouble in the new year for these stocks and rates do fall, that adds up to bank stress. And I can't predict that yet, but normally you would think that bank stocks would do well if, long-term rates are steady and, short-term rates are falling. Um, but if rates are falling across the curve, it probably isn't because we're growing. It's probably because there's a panic. And so I'm watching for that with no conclusions. Okay. I talk about biotech looking weak, which, by the way, biotech, healthcare, they tend to go together. The markets are so correlated. So it's great that healthcare has had a nice run, but it looks a little gassed. Um, So let's see, Tesla, I mean, do more ETF work than stock work here, but what are ETFs in a lot of cases? Baskets of stocks. So, Tesla hasn't really made its move yet, but I will tell you this, in my trading accounts, which I don't talk about a whole lot here unless people want to, but Tesla has been a great trading tool. Um, and I think it will be again. These lines are pretty well drawn, and if you see it dip over enough here, you will end up, yeah, in in some trouble unless you are using either Tesla puts, which are expensive, or you are using the inverse ETFs. And that's also a subject for here, which I'll mention in a second. Okay. I did actually add a little bit to the Bitcoin position. This is not the best chart, but Bitcoin being Bitcoin, okay, updated today. This is probably one of the more instructive sort of get inside my head pieces that you'll see. How this Bitcoin move, not look, everyone's talking about, oh, what's Bitcoin going to do? I have no freaking idea what Bitcoin's going to do. I know that it is getting a little bit warmer, a little bit, but that's not the only thing that matters. What also matters is I'm running a portfolio for myself. And I decided at the beginning of it, from 30 something years of portfolio construction work, that 2 to 10 is my range for Bitcoin. Any more than 10, I'm going to get the heebie-jeebies, as they say. Anything less than two, well, if you're not at least investing 2% in something, unless it's this, wild card volatility thing. If you're not at least investing 2%, then it's not going to have an impact. So I was at 2%. Now I'm at 5. Not a big deal, but it's another 3% in Bitcoin I because I could afford to. Okay. It's kind of like saying, hey, you know what? Should I take a little shot here with 3% on my portfolio? Yeah, I can because I've got a hedge in here and I've got a hedge in here and the gold is working well. And I was 21% in cash and I'm 18. Okay. I mean, there's so many ways and I've allowed myself to go up to 70% cash. I'm not going to be whipping back and forth. But again, this is all driven by sort of my eyes, my experience, and a little bit of quantitative analysis, which created the Roar score up until now. But now it is automated to the point where I think very soon it's going to be able to come to me and say, here are all your Roar scores. Um, and I can look at that and say, all right, well, can you also, it's almost like talking to AI, which by the way, I highly recommend because I mean, I'm building a whole new like side business on it, unrelated to investing. AI, I mean, I don't know if enough people are going to care about it to make it profitable, within the next 5 to 10 years. But it is quite amazing what it can do, taking what's already out there, and if you know how to ask it the right questions and to follow up and to keep it from being too wonky or making little mistakes, unbelievable, unbelievable. Can't use it in a lot of my writing like it's Seeking Alpha, but we can certainly use it here. We probably will be using it. But I can also start to do things like say, okay, here are my Roar scores. What should my portfolio be? And as long as I've given it, I mean, look, it's still intellectual property. So uh, I tell it what I want. I tell it what these are. Okay. And we want to make it so that anybody can do that with maybe a handful of clicks. You still have to know yourself as an investor, as a do-it-yourself investor, um, and it helps to be able to ask questions. But wouldn't surprise me at some point if our subscribers were getting this some type of toolkit, automated toolkit. That's the goal. Uh, you'll get it, and everybody else who's not a subscriber, they'll have to pay for it. So that's a hopefully going to be a really big benefit of being part of this group and any of our services in 2026. So this is a good time of the year to bring it up. Um, I'm going to do some more of this because we're trying to expand this a bit. We used to have all this in a spreadsheet, and it was a little bit cumbersome. So here, our final thoughts for this week were. Um, Here are just about 50 ETFs. What do these do? Gee, I really don't like where Apple's going next year. I'm not saying that. I don't like where most stocks are going, but let's just pick on Apple for a minute because it's the first one on the list. I don't love option. I don't want to buy put options on Apple. I might make a mistake when I trade it or whatever. And selling covered calls on it, I mean, all that does is bring me a little bit of cash now, and I have all the downside. What if I'm just like, I don't want to own Apple, and in fact, I'm pretty convinced Apple's going to go down. Wouldn't it be great if I could make money on that if it turns out to be the case? Same with almost any stock. Well, for a lot of stocks, you can just buy an ETF now. Okay. So that's what this does. AAPD, if you look at a chart of Apple and you look at a chart of AAPD, except for the fact that these got to be careful because math of loss and they're a little bit different and they're newer and they're not as liquid, but they do what they're supposed to do. If Apple goes down 10% in a matter of days, this thing will be up about 10% in a matter of days. Okay. And then the math from there, because it resets every day, but that's what it's doing. It's giving you the opposite of whatever Apple did. In fact, here, AAPD, let's put this to the test and hope it works. All right, Apple down a quarter today. AAPD up 23 bips. It's almost never precise because when you go in the opposite direction, but that's what's going to happen. Okay. This is not one Apple. I would pretty much guarantee you that Apple had a rough go between the start of the year through about mid early April, like the whole market did. And sure enough, here we go down to the day. It's just the opposite. That's all it is. And there's like 50 of these so far. Now, there's some double counting here because Tesla, being a popular short as it is, uh, everybody wants in on this game. So the folks at Trader have a 2 times short Tesla. This is one I've used a lot, TSLS for the bear. And they have long versions too. You need 2 times long. And I use those a lot. Why? Because as I see it, if I really think Tesla's rolling over, first of all, it's trading, it's not investing. So I'm going to take a smallish position. But if I know I'm going to own it for days to weeks, why not just put half his money at risk just in case and double short it? That's my approach. Um, and so here's Taiwan Semi and MSTR, the Michael Saylor crypto thing, strategy, I guess they call it. Hard to tell what a strategy is right now, right? But that's the name of the company. And here's Shopify, Rocket Lab, Rigetti. You're not going to find too many of these on the slow movers because everybody. This is like the casino of the market. However, if you know what you're doing and you are humble and you don't put a lot of capital at risk and you learn as you go, because that's what I did. These things didn't exist before probably a year or so ago. Um, I just started experimenting with it, and now it's kind of a portfolio. In fact, I keep 2 lists in my bar chart. I keep these inverses, and I also keep the underlying name. So I have a separate list that says, okay, Apple, AMD, Amazon. So all I have to do is look at my list, scan through the charts, and say, those look pretty weak to me. Well, I can go and look. I mean, look, there's even one for Berkshire Hathaway, Boeing. So, I mean, all the Mag Sevens are in here. There's a lot of them. Ford, Lilly. Okay, so you got a bunch of them. Not enough to create a full portfolio, but definitely enough to create a diversified portfolio. I could probably, and maybe I will. Again, we're driven by subscriber interest, or if I just want to do it myself and I'll share it with you. But one of the things I'm looking forward to doing again with the automated roar scores, okay, it's why everything kind of works off of this. If I go here, let's see, uh, stocks with inverse ETFs. Gee, I wonder what's on that list. I guess it's stocks with inverse ETFs. And I can just go right to here. And right now I'm doing this manually. I'm saying, okay, these have inverse ETFs. Do any of these charts look really crappy? Well, Boeing's not quite there yet. Um, but I'm looking for like really bad charts. Well, I mean, Coinbase would appear to be in secular decline, but we'll see. You know, I already know if it's on this list and they're growing all the time, they're bringing out more. There's either a -1 or a -2 ETF for that. Okay, see, Cisco I mentioned doesn't look that good. Okay, so I can go through here and I pick them out. Well, it's not just about betting on the downside here and say betting because these are trades, but I should also let you know that, I mean, for every one of these, you also have the stock that you can just buy regularly. You can buy Apple, or you can short it. You through an ETF, you can buy Apple, and you can say, you know what, I like Apple. I don't love Amazon. You can create long short portfolios here, true hedge fund manager like portfolios, and simply say these are the stocks. And I mean, take the Mag 7, all right? I think all seven are covered here. You take the Mag 7, throw in a few more, say, this is my, special mega cap 10. And at any point in time, I'm either going to be long, I'm going to be short through an ETF, or I'm going to maybe be out of it. And then the question is, how much? How much? Well, that's allocation. I'm giving you a bit of a world tour of how portfolio construction works. You have to figure out what goes in. That's this. Okay. Then you have to figure out what your limits are going to be and what your sort of home base is for each one of these. And then you have to figure out where you're going to be right now. And I mean, you hear this all the time if you listen to CNBC, Bloomberg, et cetera. Well, right now, we're neutral weight in the equity market, at least the mega caps, the Qs and the DIA. We don't think as highly of the average stock, and so RSP, which is equal weight S&P 500, we're only about 50% weight in that. Normally, it'd be a 10, we're at 5. We're equal weight in commodities, but looking to maybe raise it if it's not a flash in the pan. Bitcoin is we just brought it up to neutral weight, and everybody's like, "Oh, that sounds really impressive." Okay, right? A little bit underweight bonds, very overweight cash. That tells you all you need to know right there. Everything else about equal weight. Great. Put me on television. Uh, I think I've done that on the radio and I've done it on podcasts, but I haven't done it on television. So anyway, this is portfolio construction, and you might be looking at this as some people do when they read these articles, and they say, "Wow, what a bunch of words with empty meaning." Fine, yeah, 10-20% of people who read our stuff probably have that opinion. They should not be in this group. But if you're starting to see through this monologue of mine today that portfolio construction is investment success, it's not picking good stocks. Because so what? I mean, the story of my life as an investment manager with a really conservative bent is for years, my stock selection was pretty good. I mean, probably several points ahead of the S&P 500, which was a little bit more balanced back then. But you know what? It didn't show up in my returns. That's a good little pop quiz. Why, if let's say a typical year for the S&P up by 8%, and many of those years I'm making 12, 13, 14%, on some of my equity positions and not too many losers in there. So my equities are beating the market. Why do my returns look like they're only a few points ahead of bonds? How could that be if my stock picking is so good? Thanks to my charting, which is now Roar. Anybody want to offer a guess? Position size.
Probably didn't have enough in each position to make
That's
a
it.
delta.
That's it. Position size.
Well, I
Okay.
mean, and modern portfolio theory says that returns are primarily driven by asset allocation, right? So
That's correct. And that goes all the way down. Thank you. That goes all the way down to the security level. Okay. Um, and here is maybe the best example of that I can give you. I've written about this a lot recently. Okay, how many years we go back? Oh, let's go back 10 years. 10 years won't really show it the way I want to show it. Let's see what 5 years. 5 years, not even. 3 years. There we go. Okay, great. All right. So these are two different sets of stocks. They're both US stocks. Which stocks did better? The pop quiz. Which stocks did better? Let's have everybody. Why don't you vote? You can vote in the chat, or I can just do it like this. Okay. Um, if you, sorry, I just read David's. Uh, thank you, thank you. It makes me laugh. Okay. If you saw, is this call going to end in a duel? Oh, okay. I realize now it's not because Tim piped up and started saying brilliant things. It's because I referenced Hamilton. That's why you're saying that. That is bravo, bravo.
Exactly. I'm sorry. That was a quick theater reference.
Oh my God, that was great. That was great. Okay, you are truly master of the house around here. So let's see. All right. So here's the question. Which set of stocks did better? The purple or the orange? Seems like a pretty easy question to me. Which did better? Anybody want to guess? Purple or orange? This is the beginning. This is the end. These are the percentage returns. Which set of stocks did better? Seems like the purple, right? That would be wrong. Wait a minute. 3 years, this thing, SP 500 SPY, purple, it's up 86%. You're telling me that 86 did not do better than 43? 86 is double 43. This is not a two-time ETF. It's the same 500 stocks. I was trying to trick you all, but nobody answered. So what we have here is the same 500 stocks, but when they're weighted according to how big they are, you get the 3 years we've just had, the purple line. When you weight it equally and you keep rebalancing back to equal, well, then you get the same 500, the exact same holdings by ticker. But the weightings are so different. There's 20 stocks in here that make up about 50% of the whole thing. Here, the top 20 make up what? 500 stocks, 0.2% each. Okay. So here, the top 20 make up 4%, 4%, 50% versus 4%. Okay. Can you imagine? I'll be writing about this. I just decided. But I mean, really, like, this is the stock market today. This is why it's so messed up. And frankly, why, and I apologize to those of you who have seen this for a little while. Let me go back a little further here. Let's see, where was it? Here. Okay. Let's go back 13 months if we can to November 24, 29th. Okay. The average stock has made a whopping 5% in 13 months. So that's less than 5% a year. I believe I can put my friend the T-bills in here. Ta-da. Okay. Maybe if I go SHV, which goes a little further out on the T-bill ladder. Nah, not really. Okay. So there's the S&P 500 over the last 13 months. Anybody surprised?
Yeah, it's all about the Mag 7. There was a
It's
humorous comment on
all about the
CNBC.
weighting. It's all right.
Right.
As Tom Petty famously said, the late great, the weighting is the hardest part. Except I'm WEIGHG.
So on
Yes.
CNBC this morning, one of the guys said, "Well, I'm going to rotate into defensives." In my head, I think utilities, consumer staples, maybe buy some Altria, right? No. When they say defensive now, they mean Amazon, Apple.
No.
Yeah, that's like
No.
seriously.
Really.
Yeah, right.
I'm glad we're recording this. That was a live reaction, folks. I mean, I'm immersed in this stuff all the time, and holy, wow, Tim, if you any week you want to co-host, man, seriously, your agenda, no, really. I mean, you're because you're well, you're well versed. Um, so this is let's see. Somebody asked about top T, okay, which is the 20 biggest stocks. Well, yeah, you would expect. There's your top 20. Okay. And let me see. Was there a question there? SPY versus RSP. Why have you stopped using top T? Oh, because top T doesn't go back that far. That's all. That's all. And because people are so familiar with the S&P. Top T only goes back to uh, 14 months. iShares didn't create it until 14 months ago. Well overdue. Okay. But I mean, wow. Look at that. And again, if we go back to the day, so what I like to do is I like to stack them up like this. Written about this. I'm sure I'll write more about it. Here, let's just look at this year. Okay. Well, these have all kind of bunched up now. I think the last 3 years we'll probably see a bit of a difference. Yeah, a bit of a difference. Okay. But the more stocks you add, does this sound right? You start with 20 stocks, you do better. You keep adding stocks, and every time you add more stocks, it gets worse. Isn't diversification supposed to work the other way? Aren't you supposed to smooth it out? No, because if you go back to a lot of the academic studies, following what Tim was saying here, one of the other studies is that once you get to 20 or 30 stocks, the benefits of diversification start to fade pretty seriously. And especially now, because these are indexes. This is not the stock market. I mean, what's the stock market? The stock market would probably be, I don't know, does the Wilshire still exist? The Wilshire 5000? I guess it does in some form. Okay. So, yeah, in a mutual fund. All right. This used to be the whole stock market right here. The Wilshire 5000. Okay. So the Wilshire's doing pretty well this year, but guess what? It's weighted by market cap. Okay. So it looks just like the S&P because the S&P dominates. I showed you RSP. I'll show you one more. This is the equal weighted top 1,000. And let's compare that. You got me in full on geek mode here now. Okay. So, I mean, really, for the last few years, okay, you extend it out a little bit further. Remember, before it was a 2-to-1. Well, now it's a little more than a 2-to-1. The top 1,000 stocks, equal weighting. Okay, you own the same amount of every one, as opposed to here, where you own them based on size. So the biggest stocks dominate. Quite a difference there. Ironically, it's starting to turn around, but I think a lot of that is happening at the lower end. The Mag 7 just starting to fade. Last thought on this, then we'll close up unless you have any questions. Heading into next year, if the Mag 7, or let's say if the top 20, okay, because it may be less about Mag 7. Here, let's put this in here. See if there's much of a difference. Get rid of some of these guys. Okay, so yeah, they've been about the same. Okay, so the 7 or the 20. All right, let's just compare. There we go. Yeah, it's been kind of a fair fight. Okay, but the better comparison would be take the S&P, the average S&P stock here, and it's been the last 6 months, kind of a blowout. Again, this 2 to 1. Okay. So the top 20 versus the 500 equal weighted, 2 to 1. Well, it's starting to flatten out here. Last 3 months, where are we? Yeah, flattish returns. Okay. At least down. Well, maybe not positive, but since here, pretty flat. Well, what happens if the top 20 start fading? And what happens if the rest of the market starts to do better? Well, I got news for you. They're going to have to do much, much, much better because their weightings are so small. And I think I can show this to you. Boy, bar chart has all the right stuff here. Going to S&P. Let's go into constituents. Okay. Here they are, all 500. All right. This is the whole index. So there's your top 20. You know how many of these I'm going to have to go through? Check this out. Okay. It's great that News Corp and DaVita and Paramount are in the SP 500. 0.01% of the portfolio. Okay. 0.2, 0.3. I'll go a few more here. I'm going to go one more and I'm going to get to the median. Okay. This should be about, let me see, 400. Oh, I got to go a little bit further. Whoops. Oh, show all. That'll be easier. So I'm guessing based on the side here, this is the median. You're probably right about this. So stay tuned for this. So right around here is the median. So the average stock is so little. I guess we could do the math. But look at all these tiny, tiny, tiny positions. These stocks could all like double, and it wouldn't really move the S&P 500. Okay, if Lowe's were to double in price tomorrow, it would add 0.23% to the S&P 500, the whole S&P 500. 0.23. It went down by that much today. Okay. So, until you get to here, like most of these stocks don't matter because these guys are taking up all the air in the room. And you look at the NASDAQ, it's even worse, more skewed to most of these. So, yeah, that's the stock market for you. And that's why I think we have to be, it's great to be optimistic, but don't be naive and be careful. And with that, I will ask if there are any other questions before we close out the year here on the weekly show.
Yeah, Rob, I'll ask a question.
Yes,
This is
sir.
David.
Yes, sir, David.
Thank you. Thank you for the year. It's been a great year of learning for me, and
Thank you.
I'm very happy for you for the. I'm a programmer, so I understand what it means, what you've done.
Oh,
Um,
yes.
yeah. So, as far as portfolio construction goes, I know you were working on a book earlier this year. I got lost. Is it out there? Is it available to us at this point?
I am very glad that you asked. You know what? It's sort of out there, and let me tell you where it is. It's here. The book is ETF Yourself, because we concluded that people don't read books. And I have something like a book that I may put out, more like an ebook. But what we did with all this 30 years of written content that I have is we decided to take ETF yourself and say, okay, this is kind of latest news, headlines, all the posts. All right. You can get to it through sungardeninvestment.com. I'll also bring you the same place, but it's ETF for yourself now. Okay. Process. All right. Curated investment learning content. So we've got a few different things. I pretty much put all the best ideas into here. There's more coming. Dan is posting more. We just didn't want to, we wanted to post every one so that people would see it. And every time you post, you know, uh, we put out more than one a day. I think people might get annoyed. So, all right, this is important. Building a portfolio, managing risk. Here's all the weekly letters. If you're new, you can see them all. Okay. And then this will probably add a few more of these in here. Although actually here, if you've missed any of these, and if you're part of the club, you can go to our YouTube channel. You can see it there. Okay. We keep a bunch of them there. So yeah, this is pretty much what we did. If I thought that enough people were interested, I have a couple of ways to do it. I would take a lot of these pieces. This is like the learning section. I would take these pieces, we would string them together. I'd ask my friend AI, Google Gemini, to take that and some other material we pour in and say, turn this into an ebook that sounds the same but organizes it all in one spot. If people wanted that, we couldn't do it that quickly. We could do it quickly. We just couldn't do it right now, but probably within a couple of weeks we could have that done. I just don't, when you do all the writing that I do, you start to realize that the masses don't read long form anymore. But you guys are not the masses. You're our subscribers. So, and our club members. So, as far as I'm concerned, if some people want to see that, we'll move that up the priority list.
Well, thank you for that. I have not been using the ETF Yourself website at all. So this is great. I didn't even realize
Yep.
you were doing that. So.
Yeah, we tried to put it out there. I don't know if we put it in every week, but yeah, this is your knowledge hub right here. It's all there. And I mean, we made a couple of announcements, but this is it. Yeah, this is the home of everything, everything.
No, I did not miss the announcements. I saw it. It's just I haven't gone there yet.
Okay,
So
okay.
it's just me not being on top
Yeah,
of
that's
it.
okay. And then and look, Seeking Alpha gave us a decent sort of resources tab, but I think a lot of us would agree that the last thing we need is like another place to go for stuff. So we just decided it's all here. That's why and putting these things in here as uh, as one big knowledge hub. Okay.
Perfect. Thank you.
All right. And by the way, I mean, you might see them flash up, but literally every day somebody is subscribing to the ETF yourself, which is, like the lighter version, $150 a year. We only just started going back to it a little while ago, a couple months ago. But we've already surpassed the popularity that we had a little over a year ago when we took it off Substack, moved it all to Seeking Alpha, and then we said, nope, we have to have both, and we have to have a couple of different levels. So, but if you are part of the if you're part of the Seeking Alpha investing group, which is called SunGard Investors Club, you automatically get comped for ETF yourself. You're not paying 150 a year, you're not paying 600 a year, which is ETF yourself, but it allows you to join here. And this group at Seeking Alpha, not only are you getting all the extra posts on Seeking Alpha, but since this is ETF yourself on Substack, we don't talk a whole lot about options, about bond ladders, things like that. It's a little more like what can you do with ETFs in portfolio construction? As we like to say, learn to build ETF portfolios by yourself. That's etfyourself.com. All right. Thank you all, and have a very happy new year. And we'll see you back here next Tuesday. Start the year.